Carvana, the popular used car dealer known for its unique car vending machine.
After striking a deal to reduce its outstanding debt.
I bought a Jeep a couple of months ago. I went to a car dealer nearby, had a terrible experience.
Market looks a lot like 2021, right before stocks entered a deep slump.
Carvana denies any wrongdoing. They declined to do an interview. But in a statement, they say they bought and sold over 1 million cars and have a 4.7 out of 5-star rating on their website.
It sounds like the perfect plot to a finance thriller. But what if the truth behind his story is darker than anyone could imagine? From humble beginnings to ex-con to startup billionaire, the ringleader behind all of this is none other than Ernest Garcia II, who went from bankruptcy to a net worth of nearly $10 billion. But what began as an inspiring underdog story of the late 1950s quickly turned into financial ruin for thousands of Americans in one of the USA's biggest economic downfalls. The chilling details you're about to uncover have rocked both the banking and car sales industries. This is a tale riddled with deceit, manipulation, and dark family secrets. Founded in 2012, Carvana revolutionized car buying by simplifying and modernizing the car buying process with a user-friendly online experience where customers can finance and purchase vehicles from the comfort of their homes. The company is known for launching the first car vending machines in Nashville, Tennessee in 2015, rocking the car sales world and knocking competitors out of the park. But behind this innovative front, the company's insane growth and financial practices have raised a slew of red flags, leaving many unanswered questions. The entire operation was founded by the infamous Garcia family, a powerful and influential dynasty in the world of used car sales. Enter Ernest Garcia II, the patriarch of the Garcia family, an ambitious businessman shadowed by controversy, even pleading guilty to felony fraud in 1990 for his involvement in the collapse of a financial institution. That's right, an entire financial institution. The family's story is one of rags to riches, with dark secrets that make their rise to prominence extremely fascinating and even more unsettling. Born in 1957 in Gallup, New Mexico, Garcia's father co-owned a small liquor store and struggled to make a living for his family. While his childhood was marked by modest means, his ambitions were anything but. Although Garcia was a high school dropout, he was determined to build wealth and eventually went on to study business at the University of Arizona. After graduating, he went into real estate, banking, and securities. And that's where everything changed for the relentless entrepreneur. In the 1980s, Garcia's destiny took a turn when he met Charles Keating, the head of Lincoln Savings and Loan, a financial institution that primarily dealt with savings accounts and home loans. Despite having limited collateral, Garcia suspiciously secured a whopping $30 million loan for his real estate company from Keating. But these deals were part of a larger scheme that would ultimately send the entire US economy on a downward spiral. So, just how did Garcia help to bring the strongest economy of the 90s to its knees? It all boils down to one moment that would taint the Garcia family name forever. Ernest Garcia agreed to become a business associate of Lincoln Savings and Loan, where Keating had begun to orchestrate questionable real estate activities. Here's how it went. Garcia purchased property from Lincoln Savings and Loan at an inflated price, which helped the institution appear more financially stable than it actually was. These real estate deals were designed to inflate prices, mislead regulators, and cheat investors about the true financial health of the business. More than a strategy, it was a ticking time bomb, and the truth soon began to surface. When the fraudulent activities came to light, a broader investigation ensued, uncovering widespread financial misconduct. Fast forward to 1990, the modest boy we once rooted for from New Mexico was now 33 years old and pled guilty to felony bank fraud charges related to his involvement in the scandal. Garcia's plea was part of a broader investigation into the fraudulent activities that led to the collapse of Lincoln Savings and Loan. His full cooperation in the investigation conveniently helped him avoid prison time. In fact, he paid a measly $50 fine and a 3-year probation, leaving taxpayers with over $3 billion in costs, and led to widespread financial reform in the banking sector. His real estate company filed for Chapter 11, and he soon declared personal bankruptcy. But despite losing everything, he went on to build a business empire, even passing the torch to his son, Ernest Garcia III. So how exactly does one go from bankrupt felon to billionaire entrepreneur? After his legal troubles, Garcia left real estate for car sales. In 1993, he bought assets from the bankrupt Ugly Duckling, a rent-a-car system founded in 1977 by a retired insurance salesman, transforming it into a subprime auto loan and car sales business where Garcia targeted customers with poor credit, trapping them in a cycle of debt and often ending in financial ruin for the borrowers. He aggressively expanded Ugly Duckling by acquiring small used car dealerships and turning them into high-interest loan centers. By 1996, only 3 years after he acquired the business, it went public, raising significant capital to reduce debt and fuel further growth. However, Ugly Duckling's success relied heavily on its ability to exploit financially vulnerable customers. But this wasn't enough for the money-hungry Garcia. To boost sales, Ugly Duckling introduced several programs, including using tax refunds for down payments. He coupled these incentives with high-interest loans and additional fees, making it impossible for borrowers to pay their debts off. The company's hostile tactics led to moral concerns surrounding Garcia's business model, resulting in several lawsuits from customers who felt exploited by their high-interest loans and unethical collection practices. So Garcia did what any savvy ex-con entrepreneur would do. In 2001, in a drastic move, Ugly Duckling Corporation was rebranded into what you may recognize today as Drive Time. But what was disguised as a cosmetic change was actually a strategic move to distance the company from its controversial past and legal troubles. By adopting a new identity, Garcia aimed to shed the negative reputation associated with Ugly Duckling and position Drive Time as a reputable and customer-friendly brand. This sneaky move was part of a broader financial strategy to attract new investors, reduce debt, leverage the growing demand for used cars, and solidify Garcia's position in the automotive industry. And while the plan seemed to work, Garcia's story doesn't end with Drive Time. In fact, he was just getting started again. Drive Time's success provided the financial support for Carvana, which was launched by his son, Ernest Garcia III, in 2012 to capitalize on the exploding trend of online car sales. Born in 1982, Garcia Jr., aka Ernie, lived anything but a normal life under the shadows of his father's controversial footprints and fraudulent past. By the time Ernie had reached his 8th birthday, his father was being investigated for his role in one of America's worst financial disasters. When he was just 9 years old, his father had already become a convicted criminal felon, and his family had gone bankrupt. But despite all this, Ernie still managed to earn a bachelor's degree in science and engineering from Stanford University at only 23 years old. He followed in his father's footsteps in finance, landing a job with the Royal Bank of Scotland Greenwich Capital as a private equity analyst. A few years later, he returned to Arizona, where things got quite interesting. He spent 5 years working for his father in Drive Time before co-founding Carvana at only 30 years old, becoming one of the youngest CEOs in the nation. A drastic move that would change the course of his entire life. Carvana's innovative digital business model was a huge step up from the traditional dealership model used by Drive Time. But something wasn't quite right. Carvana experienced unusual rapid growth and quickly became a dominant player in the online car sales market. The young CEO then took the company public in 2017, only 5 years after its inception, making Ernie a startup superhero among investors and entrepreneurs. These moves allowed the Garcia family to diversify their business interests and tap into different segments of the automotive market. While DriveTime continued to focus on subprime borrowers through physical dealerships, Carvana targeted tech-savvy consumers looking for convenience and transparency in car buying. Although operating separately, both companies could leverage synergies in terms of inventory management, financial infrastructure, and operations. But the Garcias had even bigger plans. With DriveTime and Carvana, the family could expand their influence across different market segments, maximizing their reach and profitability. This dual approach allowed them to hedge against market fluctuations and capitalize on varying consumer preferences. But beneath this success, the company's foundations were far from solid. The Garcias control 88% of the voting shares through a dual-class shareholder structure, essentially turning Carvana into a dictatorship. As the 2022 10K filing starkly warned, the interests of the Garcia parties may not in all cases be aligned with our stockholders' interests. Could the Garcias be hiding something behind Carvana's glossy surface? Even though the alarm bells were ringing, you won't believe what happened next. In 2023, Forbes stated that Carvana's more than 1,000% share price gain year-to-date makes it the biggest gainer of any company listed on the Russell 3000. And on May 1, 2024, Carvana reported earnings that left analysts and investors astounded. The company beat earnings expectations with a net income of nearly $50 million, against analyst predictions of $116 million in losses. Meanwhile, other car companies like CarMax and CarGurus struggled to meet their targets. This astonishing result caused Carvana's stock to soar by 35% in a single day, a rare movement that often results in more concerns than celebrations. How could Carvana achieve these results when the entire industry is in shambles? And more importantly, what do the Garcias have to do with it? The key to understanding Carvana's financials lies in its intricate relationship with DriveTime, which operates over a whopping 140 dealerships across the United States. This is where things really start to get unnerving, as Carvana's IPO turned Ernie Garcia III into a billionaire. The legal repercussions from their DriveTime days continued to surface. The Garcias faced multiple lawsuits, including one particularly damning case that highlighted systemic issues in how DriveTime managed its loans. But this only seemed to tickle the Garcias as they made another bold move in 2013 when DriveTime became Carvana's majority owner. Though separate entities, their unusual and complex financial transactions blur operational lines and raise widespread concerns. Imagine a company that sells its own debt to another sister-like company to appear more financially stable. Here's what that looks like. The Garcia family owns and controls both Carvana and DriveTime. Carvana transfers its debt to DriveTime to appear more financially stable. By moving debt to DriveTime, Carvana appears more attractive to investors. This relationship raises serious questions about transparency and financial integrity. If DriveTime is being used to prop up Carvana's financials, what does that mean for investors and customers? The deeper you go down this rabbit hole, the more you uncover a web of dubious transactions that could be hiding significant financial warning signs. In fact, since November 2013, Carvana has been selling off its debt and cars to DriveTime, creating an illusion of financial health. What could these transactions actually be hiding? Although Carvana and DriveTime are not legally related, the family ties and stakes make it seem like intercompany transactions. On paper, it looks like two completely separate businesses. But when you consider who is really calling the shots, it's clear to see what could really be going on. In 2021 and 2022, a shareholder lawsuit alleged that Carvana paid $406 million to Drive Time, a sum that is equivalent to a third of Carvana's gross profit in 2022. Are these financial maneuvers a clever strategy or a deceptive practice? You be the judge. Let's take a look at some numbers. Carvana boasts a market cap of $25 billion, compared to CarMax's $11 billion. Yet, CarMax sold 370,000 units in Q1 2024, while Carvana sold only 91,000. Additionally, Carvana operates with 13,000 employees versus CarMax's 30,000. How can a company with fewer resources and lower sales command such a high valuation? Carvana claims almost $7,000 profit per unit sold, dwarfing both CarMax's $2,200 and the National Automobile Dealers Association's average of $2,300. Something isn't quite right with these figures, given CarMax's longer market presence and industry expertise. Can Carvana's profit claims be trusted, or are they too good to be true? Let's take a closer look at their operations to see just how far the family will go to stay afloat. Carvana operates on a first-in, first-out model, also known as FIFO, which means selling older, high-cost inventory first. In theory, this should squeeze profit margins. Most of Carvana's inventory was acquired during peak car prices in 2022. Selling these older, high-cost cars first can squeeze profit margins, raising questions about the company's profitability claims and financial practices. But is this inventory strategy sustainable in the long run? You won't believe what the Garcias did next. In yet another daring move, Carvana purchased the car auction company ADESA, with 56 locations across the US. The acquisition of ADESA by Carvana might seem like a strategic expansion on the surface, but the underlying motivations and implications suggest a much darker reality. By adding ADESA's extensive network and operations to its portfolio, Carvana can present a much larger and seemingly more valuable company to investors, once again creating false growth and stability. The ADESA acquisition opens yet another door for Carvana to artificially inflate its figures through intercompany transactions, like selling cars at inflated prices or transferring assets to boost sales numbers. Could Carvana be using ADESA to paint a rosy picture of its financial health? Imagine investing in a company where the insiders, the very people who know the business best, are selling off their shares at an alarming rate. That's exactly what's happening at Carvana. Over the past 3 quarters, the Garcia family has been selling their shares aggressively. According to insider trading data, they have offloaded significant amounts of stock, raising eyebrows and sending a clear message to the market. It seems like everything that we've been taught to believe about market efficiency is nothing short of an illusion. Many investors base their decisions on the efficient market hypothesis, EMH, a financial theory that suggests stock prices incorporate and reflect all relevant information. Passive strategies, like investing in index funds, are grounded in the belief that it is difficult to beat the market consistently. It focuses on matching the market's overall performance, which EMH suggests is the most reliable approach over the long term. Essentially, EMH argues that the market is perfectly efficient at pricing securities. But Carvana's recent actions raise serious questions about the validity of this theory. Despite a series of shady financial maneuvers, Carvana's stock remains highly valued. This discrepancy suggests that the market may not be as efficient as we've been led to believe. Carvana's acquisition of Adisa is a prime example of how strategic moves can inflate a company's perceived value by adding a significant revenue stream and asset base to its portfolio. On the surface, this seemed like a smart business move, but behind the scenes, it merely provided a convenient way to manipulate financial figures. Another critical factor is the aggressive share selling by the Garcia family. If the market were truly efficient, as the EMH hypothesis claims, such insider activity would trigger a reassessment of the company's valuation. Yet, Carvana's stock price remains resilient, defying the very principles of the theory. We continue to observe a series of tactics that mislead investors and distort the market's perception of the company's true value. If Carvana's valuation is indeed a mirage, the market's delayed reaction to these red flags could lead to significant financial repercussions. This case forces us to rethink the entire efficient market hypothesis. If a company can manipulate its financial image so effectively, what does this say about our ability to accurately assess true value in the market? Are other companies employing similar tactics, creating an unseen layer of risk in the stock market? To fully understand the gravity of these risks, we must look back at the origins of Carvana and the Garcia family legacy of financial manipulation. From Ernest Garcia, II's humble beginnings in New Mexico, to committing felony bank fraud, his story has been one of ambition guided by greed. The transformation of Ugly Duckling into Drive Time, the inception of Carvana and his son, Ernest Garcia III, along with the rapid expansion into Carvana, reveal a pattern of financial manipulation and strategic deceit. While the Garcia family's aggressive insider selling, the dubious Adisa acquisition, and the simulation of market efficiency paint quite a chilling picture. So, as we pull back the curtain on Carvana, we see decades of shadowy practices and ethical compromises. The Garcias seem to be true masters at creating illusions of prosperity. But how long can this house of cards stand? The dark legacy of the family's empire serves as a stark reminder that beneath the surface of explosive growth and innovation, there often lies a web of deception waiting to unravel. So, what do you think? Is this the beginning of the end for Carvana? Or do you think the Garcia family has more tricks up their sleeve? Leave your predictions in the comments below and stay vigilant. If you found our investigation insightful, please don't forget to like and subscribe. Thanks for watching and stay tuned because we're brewing up more fascinating stories that you won't want to miss. Remember, this video is based on our research and opinions. Do your own research and form your own opinions.